What if I told you that in 2024, nearly two-thirds of professional fund managers couldn't beat a simple index fund? And that this isn't some fluke, it's been happening for over 2 decades. Today, we're diving deep into the SPIVA Global Scorecard for 2024, and the results might shock you. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Let me paint you a picture. Imagine you're at a casino, but instead of gambling with cards, professional fund managers are gambling with your money. The house always wins, right? Well, in 2024, the house was passive index funds, and they crushed it. The SPIVA Global Scorecard tracked over 8,400 actively managed funds across 56 categories worldwide. The results? A staggering 64% of these funds failed to beat their benchmarks. That's like having a basketball team where only 3 out of 10 players can make a free throw. But here's where it gets really interesting. The underperformance wasn't just a small margin. We're talking about professional managers with teams of analysts, sophisticated models, and years of experience getting beaten by simple computer programs that just buy and hold index funds. Why did this happen? Think of the stock market in 2024 like a basketball game where only the tallest players could score. The biggest companies, your Apples, Microsofts, and NVIDIAs, completely dominated. Here's a simple way to understand market concentration. Imagine you have a pizza, and instead of cutting it into equal slices, the biggest slice keeps getting bigger while the smaller slices shrink. That's exactly what happened in 2024. The largest companies took up more and more of the market's weight because they kept outperforming. Active fund managers typically don't want to put all their eggs in one basket. They diversify, which sounds smart, right? But when the biggest companies are the only ones making money, diversification becomes a liability. It's like being the only person at a gold rush who decides to dig for silver instead. Let's zoom out and look at the global picture. Whether you were investing in the US, Europe, Japan, Canada, or Australia, the story was the same. Global equity funds had underperformance rates between 70% and 85%. Think about this for a moment. These aren't amateur investors. These are professionals managing billions of dollars, and 7 to 8 out of every 10 couldn't beat a simple index fund that you could buy with a few clicks on your phone. The US component was particularly brutal. Between 57% and 78% of US equity-focused funds across different regions couldn't beat the S&P 500. It's like having a race where most professional runners lose to someone riding a bicycle. But here's what's fascinating. The problem wasn't just in the US. European markets saw similar carnage. In Switzerland, France, and Germany, 85% and 88% of local active funds underperformed respectively. Now, before you think active management is completely dead, there were some surprising winners. Understanding these exceptions is crucial for smart investing. US small cap funds had an incredible year. A massive 85% of them actually outperformed their benchmark. Why? Small companies are like hidden gems that big institutions often ignore. There's less research coverage, less media attention, and more opportunities for skilled managers to find undervalued companies. Think of it like shopping at a local farmer's market versus a big supermarket. At the farmer's market, you might find amazing deals because fewer people know about them. That's essentially what happened in small cap stocks. Here's where things get really interesting. While equity managers struggled, bond managers had a much better time. Out of 12 fixed income categories, 9 showed majority outperformance. Why? Bonds are like a different sport entirely. While stocks are like trying to predict which horse will win a race, bonds are more like being a detective. You're looking for clues about credit quality, liquidity, and duration risk. The star performer, U.S. investment grade short and intermediate bond funds where only 13% underperformed their benchmark. That's incredible. It's like having a basketball team where 87% of players make their shots. Let me explain something that most people don't understand about modern markets. We're living in an era of extreme market concentration. The biggest companies aren't just big, they're massive compared to everything else. This creates a huge problem for active managers. They're trained to diversify, to not put too many eggs in one basket. But when those few baskets contain all the golden eggs, diversification hurts performance. Here's a concept that might blow your mind. In 2024, stock returns were positively skewed. What does that mean in plain English? Imagine you're fishing in a lake. Most fish are small, but there are a few massive fish that weigh more than all the small fish combined. If you're trying to catch fish by weight, you need to catch those few big ones, not lots of small ones. That's exactly what happened in stock markets. A few stocks had massive returns that pulled up the average, while most stocks had mediocre or poor performance. For active managers trying to pick winners, this is like trying to find a needle in a haystack. Here's something most investors never consider: currency effects. Japanese global equity funds got hammered partly because of currency hedging decisions. When the Japanese yen weakened significantly, funds that hedged their currency exposure actually hurt their performance. It's like buying insurance for your car and then having the insurance company charge you extra when you don't have an accident. This shows how complex active management really is. It's not just about picking good stocks. You have to get currency decisions right, sector allocation right, timing right, and dozens of other factors. The beauty of the SPIVA Global Scorecard is that it shows us how universal these challenges are. Whether you look at Australia, Canada, Latin America, India, or South Africa, the story is remarkably consistent. In Australia, 72% of global equity funds underperformed. In Canada, it was 82%. These aren't developing markets with inefficient pricing. These are sophisticated financial systems with professional managers. Latin America showed some interesting patterns. In Brazil, 89% of large-cap funds underperformed, but in Mexico, only 42% underperformed. Why? It comes back to that lottery ticket analogy. In some markets, there are more winning tickets than others. Let's talk about something that doesn't get enough attention: fees. Active funds typically charge much higher fees than passive funds. Even if an active manager picks stocks perfectly, they still need to overcome this fee hurdle. It's like running a race where you start 10 meters behind the starting line. You might be a faster runner, but you're starting with a disadvantage that gets harder to overcome over time. The math is brutal. If an index fund charges 0.1% annually, and an active fund charges 1.5% annually, the active fund needs to outperform by 1.4% just to break even. Over 20 years, that fee difference compounds into a massive headwind. Why is active management getting harder? Think about information flow. 20 years ago, if you discovered that a company had great earnings, you might have hours or days before everyone else found out. Today, that information spreads in milliseconds. High-frequency trading algorithms can process news and execute trades faster than any human can even read a headline. It's like playing chess against a computer that can calculate 1,000,000 moves ahead while you're still thinking about your first move. This doesn't mean active management is dead, but it means the bar keeps getting higher. The opportunities are smaller, more fleeting, and require more sophisticated tools to capture. So what should you do with this information? First, understand that past performance doesn't guarantee future results, but 20+ years of data creates a pretty strong pattern. If you're investing in large-cap US or global equity funds, the odds are heavily stacked against active management. You're essentially betting that your fund manager is in the top 30 to 40% of all professional managers and staying there consistently. For small-cap stocks or certain fixed income categories, active management might still add value, but even then, you need to be very selective about which managers you choose. The safest approach for most investors: a core portfolio of low-cost index funds with perhaps small allocations to active strategies in areas where they've shown more consistent success. Here's something really important that most people miss. The SPIVA data corrects for survivorship bias. What does that mean? Imagine you're looking at restaurant reviews, but you only see reviews for restaurants that are still open. You'd miss all the terrible restaurants that closed down. That would make the average review look much better than reality. The same thing happens with mutual funds. Poor performing funds often get shut down or merged away. If you only looked at surviving funds, active management would look much better than it really is. SPIVA includes all funds that existed at the beginning of each period, whether they survived or not. This gives us the true picture of what an investor's odds were when making their initial investment decision. Does this mean active management is doomed? Not necessarily, but it does mean the industry needs to evolve. we're likely to see more specialization. Managers focusing on specific niches where they can still add value. We'll probably see lower fees as competition intensifies. And we'll definitely see more hybrid approaches that combine active and passive strategies. The key for investors is understanding when and where active management might still work and being realistic about the odds. Let me leave you with 3 key takeaways from the 2024 SPIVA data. First, if you're investing in broad market equity funds, passive index funds have a strong track record of outperforming active alternatives. The data is overwhelming. Second, there are still pockets where active management can add value, particularly in small cap stocks and certain fixed income categories, but you need to be selective. Third, fees matter enormously. Even a great active manager can be undermined by high fees over time. For most investors, a simple portfolio of low-cost index funds will likely outperform complex active strategies. It's not exciting, but it works. Remember, successful investing isn't about finding the next hot stock. It's about understanding the odds and making decisions that work over the long term. The SPIVA data gives us those odds, and they strongly favor keeping things simple. What's your experience with active versus passive investing? Have you found active managers who consistently beat their benchmarks? Let me know in the comments below. Don't forget to hit that subscribe button and ring the notification bell. And if you want to stay ahead of these market trends and get daily insights into when active versus passive strategies might work best, consider joining our membership for just $1 per month. You'll get the kind of analysis that helps you make smarter investment decisions before the information becomes public. It's less than a cup of coffee, but it could save you thousands in investment mistakes. You can find the sign-up link in the description below. Until next time, keep growing that wealth.